Welcome to Money Sense. I'm Jamie Williams, Wealth Advisor with Ellenbecker Investment Group, and today I'm with Mary Brown, President and Portfolio Manager at Campbell Newman Asset Management here in Milwaukee. Welcome to the show, Mary.
Thank you, Jamie. Happy to be here.
So welcome, Mary. You've been a long-time partner, strategic partner, and friend of EIG. Your relationship goes back with our founder, Karen Ellenbecker, for decades. So today we're very blessed to have you here and to talk about your strategy.
Thank you.
So why don't we start with a little bit about you, share history about Campbell Newman, how maybe your father started the company.
Exactly.
And what you guys specialize in.
Great. Okay. So as you said, Campbell Newman was founded by my dad, and also Mr. Newman, and he was the Campbell and Campbell Newman. And Mr. Newman had an investment advisory firm that he founded in Milwaukee in 1936. And then my dad worked for him for 5 years in the 50s before he was hired away by Loomis Sales, where he became the manager in the Milwaukee office. And then he was on their investment committee and on their board of directors. They were headquartered in Boston. Then in 1976, when Mr. Newman was looking to retire and find a place for his clients, they came together and formed what was then known as Campbell Newman Pottinger and Associates. They were, really eclectic investors, bottom up. And then it was during the 1980s and 1990s, we became known as a high quality, large cap growth investor. I joined the firm in 1986. It wasn't really a natural thing to have happen, as I was an English literature major, studio art minor. But it was the summer of 1986. And I was living in Boston. I was looking for a new job because I had been cooking and I didn't want to do that for a living.
Sure.
And my dad said to me, "Mary, we're at the very beginning of the greatest bull market of my generation. Come work for me. I'll teach you the business." And I never imagined almost 40 years later, this is what I would be doing, and that really I'd find my life's work.
Oh my goodness. How incredible is that to have
so lucky.
Your father and then the late 80s.
Yeah.
Greatest bull market.
He even knew my grades and he hired me anyway. But
So it was at that moment then that you decided this is for me, or how did you enter it?
Well, I entered it knowing nothing. I mean, I think today I'd be called a Nepo baby, but I enrolled at Marquette and took some accounting classes, took statistics classes, enrolled in the Chartered Financial Analyst, the CFA program, and earned my CFA designation. And I think that what I discovered was this industry is so much different than what I thought it was. I thought business was boring. It was just spreadsheets and numbers, but instead it's really about stories. Yeah. And you have to understand financial statements and be able to analyze them, be able to listen to managements, have them tell you what they want to tell you. Does it match what's going on the financial statements? Does it make sense? Sure. Do their end markets support it? All that. But it's really the best industry for people who, love to learn, want to know what's going on in the world, because it's the confluence of everything.
Absolutely. That's incredible.
Yeah.
So we have a strategic partner with Campbell Newman. For many of our clients that have been with us and maybe have a specific type of portfolio structure, we may introduce, the large cap dividend growth strategy, which we're going to talk about today. Specifically, we're going to talk about dividends. That's I think we could just have a great segment on dividends alone, because dividends are something that not all stocks pay. Correct?
That's correct.
Amazing. So my earliest experience with dividends was my mom. I was probably less than 10 years old. She took me to the bank and taught me about how banks work. Eventually, I ended up working in the banks. And then she introduced me to utility companies and said, let's dollar cost average into these companies because they're great. That's a great area. And they pay a dividend. And so I learned early on how important dividends are. So Let's jump in because you said the story, and I love the Campbell Newman story.
Mm-hmm.
I think it works so well, and our clients, many of them who have had the strategy for years, understand it.
Mm-hmm.
Let's talk about how you approach the dividend portfolio.
Mm-hmm. Very good. Well, the dividend growth strategy really grew out of the bear market of 2000 to 2003, where in talking with clients, we heard, we really like working with you. We believe in what you do, but we want lower levels of volatility and higher levels of current income. And that caused Tom Bolgert and me to start to do the research into what dividends meant to total return, what they meant to dampening volatility, but most importantly, it's a signaling effect from management as to their confidence in future earnings growth. We think these companies that pay a meaningful dividend and then increase it year after year are showing you with a non-retrievable cash payment out to shareholders that they're going to manage shareholder capital in a manner which promotes more consistent and reliable earnings growth. And earnings growth drives stock prices. So it's a total return strategy. It's not a high yield strategy designed to outperform over a market cycle with lower levels of volatility. Volatility doesn't cut equally both ways. You go down 50%, you have to go up 100% just to get back to even, right?
It's really something.
And so what is interesting too, we're a true dividend growth strategy where we require annual dividend increases. And our research found that once a company initiates a dividend, very few companies increase it the second year, third year, fourth year. Once you get to 5 years of annualized dividend increases, it tends to become institutionalized in the company's capital allocation strategies. So that's important because then if they make a change in dividend policy, it's a signal effect. If they cut a dividend, it's telling you that they're seeing something that they don't necessarily tell you about. But what's also interesting is that's a very high bar, 5 years of dividend increases. And we start with a screening process of about 7,000 companies in the S&P Cap IQ database. Less than 5% of the companies meet that bar. So it's also a very high quality bar too, because you think of these companies that are doing this, they're going to have high quality balance sheets, good levels of discretionary cash flow, all those things that you're looking for. That again helps when times are tough to protect on the downside.
One thing that I take note, specifically in those dividend paying companies that I'm familiar with that you hold, is that they're not always value oriented.
Oh no.
They're growth oriented.
Right.
So it's probably not, a mindset for many investors out there is that, well, if it pays a dividend, maybe it's not a growth oriented type of company. So do you care to share a little bit about your stock selection and how you pick those companies?
Sure. I mentioned that we have screening criteria and the dividend's the most important screening criteria. We also require a minimum of 6% projected earnings per share growth rate because we want growth in earnings. We want growth in dividends. And we want to eliminate no growth companies. If we want companies with growing earnings because that fuels stock prices. So.
Absolutely. One of the things that I really appreciate about different types of strategies, yours specifically, is how you allocate capital. Because it's not just, looking at things and going across the board, or it's not an equal weight situation. It's not necessarily a market cap weighted. You're kind of looking at things strategically and you're using that capital from those dividends. And does it make sense to reinvest those dividends in the same companies, or do we use it differently? So
we do not do dividend reinvestment programs. That's also a bookkeeping nightmare too for when you try to sell things. So we're bottom-up stock pickers. And we have, as you know, a team of 3 portfolio manager analysts. And we work on the portfolios together. And when you look at how capital is allocated, either to individual stocks or also across the 11 economic sectors. That is based on our bottom-up analysis of each company and its prospects, And then it's kind of an art of what we think is going to do best. And, technology is the largest absolute sector weight in dividend growth portfolio. And it has been for a long time. It was well overweighted to the benchmark. And when you think of dividend growth companies, I think a lot of people wouldn't necessarily think of technology companies in the same breath. But early on, what was interesting, and now it's even come more to the fore, was the semiconductor companies.
Right.
And they were good dividend payers early on. And dividend increasers.
We're going to take a break. When we come back, I do want to talk about elements of diversification in the portfolio and, ways to think about concentration, risk, and other things. So we'll be right back after this.
Want to keep building wealth that aligns with your values? New episodes of Money Sense drop weekly. Subscribe now and continue learning how your money, your choices, and your life can work together.
Welcome back to Money Sense. I'm Jamie Williams. I'm here with Mary Brown, one of our great strategic partners from Milwaukee here at Campbell Newman Asset Management. Before our break, Mary, we were talking about active management, stock picking, bottom up. Love it. It's something that I've been passionate about since I was a little boy. So let's talk about that a little bit more, because there's a discussion around passive investing, and passive has become much more available and maybe prominent for many investors. They've got 401k plans they can put dollars in. They can mimic the S&P through an index. What makes, active management different?
Well, active management is different because it isn't just investing in a group of stocks as defined by the index. And we don't market cap weight. I mean, that's one of the biggest changes, where the weights in the index are, if it's a market cap weighted index, are determined by how big the company becomes. So that's today more of an issue than it has been in the past, because with the run in the Magnificent Seven type stocks, those have grown to be much higher they're, multi-trillion-dollar companies.
Right.
And then, so anytime you put $100 in, you're putting, I think the top 10 is close to 40% of your money into there. So one of the arguments for passive investing was a diversification argument. So that isn't the same as it was 10 years ago. But passive for a lot of people serves a very good purpose too.
Most definitely. I know there's been arguments about things, but hey, how about having some of each? Right, for sure. And one other thing that's important is, the thing about passive is there's no price discovery. And price discovery is doing the analysis and trying to understand, what is this business really worth? Instead, it's really just a momentum of what the money flows are going in and out of the market. You can get more distortion. So really, passive needs active management to work. They coexist. They're
and it's
interdependent, right? Interdependent. Yes. Yeah. Makes sense. Now, I've got examples in one of my early projects when I started in this business was to try to understand a group, not here at EIG, but at a former place I was working as an advisor. I was given essentially a list of clients that had what I used to call broken Lego kits for portfolios. Maybe at one time it was put together a certain way, something happened, it was then left to, not be fixed.
Right.
So I was tasked with fixing those things for those people. And it was a great exercise for me, because I found that people had concentrated positions in certain companies. Like, for example, maybe they worked for a company like Harley Davidson or M&I Bank, ended up owning, and now BMO took over, I think, for M&I. And so that was a great thing for me to understand why. So what's the reason behind owning this? So a lot of times people own things because of emotional decisions or they have a hunch, right? But from the standpoint of concentration and risk, How do you look at that from a standpoint of how you approach portfolio construction?
So as fiduciaries, we have stricter rules, and we limit individual stock positions to 5%. Except if they're greater than that in the benchmark. Now, we run the small cap growth strategy. There aren't any stocks in the Russell 2000 growth benchmark that are over 5%.
Right.
The S&P 500 is the benchmark for dividend growth, large cap dividend growth. And that does have some companies that have greater than a 5% weighting. So we can go up to the index weighting, but not beyond.
Sure, and that's by design. And the way that you're structured is you can trim if you need to at the right time.
And it is a risk control. It's been tough because we've had a number of very strong stocks that we've had to trim back repeatedly. It goes the other way too sometimes.
It really does. And I think back to your earlier point about how the S&P is outperforming a lot of other strategies just based on that Magnificent Seven and that AI trade. Let's talk a little bit about like downside protection, because I can count on probably one hand since 2008 how many years we've had a negative outcome for the S&P.
Right.
And I think was 08, we had 2015, 2018, 2022. So 4.
Yeah.
So with regard to active, and when we're in the index, how does that correlate with a down market?
Well, I guess it depends who you're talking to. But, the dividend growth strategy was designed to protect on the downside. And we have done that. And that's been important. In 08, again, we outperformed by a lot, and it was because of our bottom-up analysis of what was going to happen with banks. Our analysis told us that loan loss reserves were too low, and we knew that the first thing a bank will do if they have to raise loan loss reserves is that they'll cut their dividend. And so we preemptively sold our bank stocks due to that analysis before they cut their dividend, and that really protected the portfolios a lot. But then we've had a very interesting period where 0% interest rates, and sometimes with interventionists of the Federal Reserve and also our government with deficit spending, covers up some of the things that could have gone wrong but didn't.
I think you touched on a very important point, because we never know, we can't predict the future. The old saying, we don't have a crystal ball. With regard to interest rates and where we sit today, I think, the Fed's going to have a very difficult job ahead with regard to what's happening with energy and with regard to what's happening with potential inflation and unemployment, right? Yeah, I think the predictors out there say it's a pretty low chance that we may go into a recession, but we never know. Do you have any thoughts around how the dividend-paying stocks react in an interest rate sensitivity?
So we've managed this strategy since 2003. So that's been in a rising interest rate environment, a lowered interest rate environment, a 0% interest rate environment. And over time, our dividend increases have been about twice that of the S&P 500. Over the last 12 months, the average dividend increase for our portfolio was around 10% versus about 5%. And that was some of the better, the year before it was lower. So it was good to see the dividend increases. That also, it depends upon what's in the portfolio. But it's a that depends type of
course,
answer.
It really does.
If companies are really worried about what the coming quarters are, that's when you see dividend cuts or dividend suspensions are not increasing. And those are important signals for us that we take heed to.
Absolutely. COVID, right? There was a very significant period there. A lot of companies suspended dividends, and it didn't make it easy for anybody, I'm sure.
Well, we have hardwired sell disciplines that if a dividend is cut, we absolutely have to sell the stock. In normal conditions, if a dividend is not increased annually, we have to sell the stock. But during COVID and also during the 2008-2009 period, we said if they're just holding dividends steady under that time of stress, because the S&P dividend was down 21% in 2009, and our average dividend was up 9%.
That's right.
There are always places to kind of go in the market and find things. The macro trends affect one part, but then that's our job to find
what's the next opportunity.
Right.
So, well, that's one thing I really like about how you approach it. You're all doing your research, you're on calls, you're reading reports all the time to try to make sure that these stocks, that you pick belong there. So
let's hope.
Let's take a good break here for a moment, and we'll be right back after this. Money Sense is brought to you by Ellenbecker Investment Group. If you're looking for a trusted partner or ready to elevate your financial plan, you're in the right place. With multiple Better Business Bureau Torch Awards for ethics and integrity, Ellenbecker combines expertise with a team member you can trust. Meet our advisors and explore financial resources at ellenbecker.com. Welcome back to Money Sense. This is Jamie Williams. I'm here with Mary Brown. Thank you so much, Mary, for joining us.
My pleasure.
In our last few minutes today, I want to talk a little bit about how there are complex investments that exist out there. I once had an opportunity to interview somebody that wrote a book about, these costly different types of investments that people can pay a lot of money for, but maybe they don't deliver. What is our approach, or the approach of Campbell Newman, to deliver on performance within the cost structures that exist?
Well, as large cap core managers, we have seen fees go down more and more all the time because, as we talked about, indexing is a viable alternative. It's been my experience as an investor myself where by sticking with things that are transparent, that you understand what you own and why. If you can't explain what's been explained to you and you don't understand it, it's better to stay away because, most people are pretty smart. And if it doesn't make sense, that kept us out of Enron back in the day because we said, I don't understand how they make money.
Right.
And so transparency is a very important component of most people's process that keeps them out of trouble.
Yeah, that's one of the first things we do when we meet with clients and they come in. We don't just take their money and invest it. First, we go through a process with our team. And I love that because as fiduciaries, we're certified financial planners. Most of our wealth advisors have some level of training or background in that. And specifically with regard to those complex investments, we like to understand them, not so that we can tell our clients that they bought something or invested in something that was bad, but just so that we can educate them and so that they understand what their options are or how to approach that. So the planning side of it becomes such an important element of gathering and understanding and then implementing. I love the fact that we bring the Campbell Newman portfolios into the fold as an option, knowing that we have several dozen stocks in the portfolios if we incorporate both. The large cap and small cap, then we know that we're doing the right thing. How would you classify a well-diversified portfolio?
Both of our strategies are what we call high conviction diversified portfolios. We don't require exposure to all economic sectors of the market. Dividend Growth has 25 to 35 stocks in it, maximum of 35. Small cap has 40 to 55. We want each stock to earn its way into the portfolio. And if you're just buying like a little 1% of a stock, you might not be as diligent about having it earn its place in there and making it work. We're long-term, high-quality growth investors. We think if you can make good decisions on your buys and, let the company do what it's supposed to do, if your investment thesis works out, and hold them over long periods of time in the context of a lower turnover environment, you should do better. You get a lot of the power of compounding. You had mentioned during the break, about tax sensitivity.
Sure.
Not having 100 stock portfolio that's being turned over a lot, that should help you in the long run with your taxes.
We're very much about use case as well, because not every account or dollar in the entire portfolio should be invested the same way. So therefore, working with a great team, where at Ellenbecker, we bring our tax people in, make sure if we're paying taxes, it's for good reason because we're making money, or we're allocating our strategies to the right structure of account. For example, Roth IRAs versus a taxable account, those things. So I love that. I did want to just kind of follow up or share some thoughts for our listeners about the current market environment we're in now. If you wouldn't mind giving us just your thoughts on where we are before we wrap up today.
Well, with what's going on in the Middle East, obviously that's taken a lot of the air out of the room. And, it's interesting what's transpired since the end of February when the first bombs began to drop. And today, we had a big sell-off in March, and now we're pretty much back to the old highs. And you look, the S&P 500 is expected to have around 16% earnings growth this year. We're favorable on the longer term look at the market. I think that with energy prices going up and concern over inflation, that's legitimate. But the core inflation numbers that came out earlier this week were good. Employment continues to be very strong, and while valuations have come down too. So we've had a long period of extraordinary returns. And so could we expect a lower return environment potentially? For sure, because valuations aren't cheap, but we have good earnings growth. And that, if that follows through, that's really, really important. And it should get to be more back to a stock pickers market versus that very small group. Although it is a lot of the tech companies that are driving the earnings growth.
Absolutely.
Projections.
Yeah, it's created a very profound kind of market over the last few years with AI and so many other things, the hyperscalers and the way that they're funding their deals. I know one of your people on your team, Jeremy, really is very much an expert on the AI trade. So very interesting. So any final thoughts before we wrap up today, Mary?
Investing isn't a sprint. It's more of a marathon. I don't know. And I think a lot of people let short-term concerns overwhelm the long-term planning and long-term things. And so working with Ellenbecker is a great thing, because I think you guys look through that a lot too and take the emotion out of it. And, all that planning is super important, so you don't get caught up in minutia.
That's right. And I would also say the partnership between the mechanics of how we do things is really well structured. We appreciate that level of connectivity. I love the fact that, we provide the option for our clients to get to have questions answered by you. And it's not common to be able to do that with such a great organization and structure. So thank you.
Well, you're welcome. Ellenbecker Investment Group is very special to us at Campbell Newman, and we're so appreciative of this relationship.
Yeah, and I'm so glad that Karen and you partnered up early on to allow this type of thing to exist for our clients.
As am I.
Well, in closing, I would like to thank you all for tuning into our podcast today. We appreciate this. And if we've made a well-being in your financial lives, more than welcome to reach out to us here at Ellenbecker at ellenbecker.com, of course. And before we advise, before we invest, we always listen. Thank you.
Thanks for listening to this episode of Money Sense, brought to you by Ellenbecker Investment Group. If you found today's conversation helpful, we encourage you to share it with a friend or family member, and be sure to subscribe wherever you listen to podcasts so you never miss an episode. At Ellenbecker Investment Group, we believe that education is the foundation of confident financial decisions. That's why we're proud to bring you insights from experienced professionals to help you build true wealth beyond just money. Please note, this podcast is intended for general informational purposes only and does not constitute personalized financial advice. Before making any financial decisions, we recommend consulting with a qualified advisor who understands your unique situation. For more resources, visit ellenbecker.com. We'll be back soon with more insights to help you live with clarity and confidence.